Good afternoon, everybody, and welcome to our buy recommendation of Nordic Semiconductor. By conducting a joint DCF and relative valuation, we've landed on a 12-month target price of $39. This indicates a 35% upside. Our analysis bases itself upon three investment highlights: NOD's unfaltering position, its broadening market that realizes synergies, and increasing returns as a quality growth company. We're going to take you through these a bit later, but first, Ed is going to introduce a bit to the company itself.
Thank you for that, Soph. Next. NOD is a leading player within the BLE market, with a market share of 42% as of Q3 2021. NOD has a fabless business model, meaning that they don't distribute or produce themselves. We believe that this gives NOD a sustainable market advantage, as they can fully focus on developing both hard and software tools for their clients. Their revenue breakdown once again showcases their market leadership, as 96% of their revenue comes from BLE. As a part of NOD's long-term strategy, they're now moving into high-growth markets, with their investments in Wi-Fi launching this year and an order backlog of 2 times their current revenue. And our estimates suggest that they will have a revenue CAGR in the cellular IoT segment of 56%. Once again, making IoT simpler for their clients. Our weighted ESG relative analysis suggests that NOD scores at the same level as their fabless peers and above their high-growth peers, with their creating low-energy products for the future of green tech.
I'm going to take you back a bit to what Ed had said in the start about NOD moving into high-growth markets, as we talk about them being positioned in the right market at the right time. As we can see here, NOD opposed against a total addressable market set for massive expansion as demand increases for both domestic and industrial IoT products as digitalization moves forward. We believe that NOD is strongly positioned to take great advantage of this market growth. They have solid manufacturer contracts that ensure them supply going forward. Additionally, they opposed against both high growth and tier one customers that are very sticky, which ensures revenue growth for NOD going forward. Therefore, we argue that NOD is positioned for growth in the right market at the right time.
Yes, so let's talk about the synergies. This broadening of the addressable market enables NOD to realize synergies between products. NOD's R&D to sales ratio is significantly above their peers. We argue that this differences NOD in a positive way, because NOD is the current market leader within the BLE segment. We argue that NOD is going to hold this position at 42% due to their superior expertise in ultra-low power connectivity, their bold brand, their high-quality products, their loyal customer base, and their sizable backlog. These established relations will boost growth into new segments. Wi-Fi has been the #1 required technology for their customers. NOD's purchase of the Imagination Technology Group, which is a world-leading Wi-Fi development team with a proven track record of delivering advanced Wi-Fi solutions, sets NOD in a unique position as one of the few companies in the world providing all the 3 top most popular wireless technologies. We also believe that these established relations will boost growth into the cellular IoT market. NOD is currently an emerging leader within this market, which makes NOD a company enabling a world of everything connected with a limited downside. So overall, we believe that the expertise within the BLE and the established relations will indicate synergies into new markets. And we also believe that this will increase their customers' willingness to pay for their products, which we argue is undervalued by the market.
So we believe the market is underappreciating a quality growth company which matching every taste of increasing returns going forward. We estimate strong return on equity increase driven by revenue in emerging markets. As NOD's as NOD's grows its bottom line and cash reserve, we estimate dividend payouts from 2023. And we also see that it will be a forward decreasing PE ratio. By challenging our EPS estimates, we see that even our bear case would result in a long-term increase.
Yes. So let's get more into the finance. In since Q4 2020, TSMC has increased their wafer prices, which is NOD's main COGS driver. However, we believe that NOD can move these increased costs over onto its customers with an added price premium because of the synergies presented earlier and the imbalances between the supply and the demand for semiconductors in today's market. This will lead to our estimated EBITDA and margin expansions. As you can see, our estimated EBITDA margin has increased to almost 25% from 21 to 22 and to over 30% in 2028, which is above NOD's target operating model at 25%. In addition, our estimated gross margin is above their average peers group, which emphasizes this position.
Further on, we argue that we believe NOD has a solid balance and R&D expenses that set them well equipped for growth. With their high current ratio, their high R&D to sales, and their low total debt to enterprise value, this supports their growth into new markets. By that, we mean that with their increasing cash reserves, they are well equipped to both growth organically and with M&A activities to secure their high-end technology as required by their customers. Going further into the evaluation, we initially covered with a buy recommendation and a target share price of $39. This is based on a weighted valuation of DCF and the relative valuation. Our multi-stage DCF suggests a 48% upside. We have calculated a WACC of 6.2% per node, which reflects their global operations, Norwegian cooperation, and governance. Further on, we have used a terminal growth of 2.5% due to NOD's positioning in the high growth industry, whereas new disruptive technologies are highly dependent on NOD. Further, we argue that there are exposure to the digitalizations of new emerging markets. In our bull scenario, the upside potential is even larger, with an upside of 176%. To assess NOD share price in under uncertainty, we see that over 87% of our simulation trials compute a price 10% above today's share price, which supports our buy recommendation. And further, with the peer analysis, we argue that NOD should trade at a premium to peer, both due to their strong brand and market positioning, their competitive advantages, and their superior growth runway. Therefore, we have included a growth segment into the relative valuation to reflect on their trading multiples. And therefore, we have concluded with a relative valuation with a target price of $35.
Finally, there are no high-impact, high-probability risks that we have identified when analyzing the company. We've looked at both market, political, and operational risks, and definitely want to go more into this in questions if we have time. Finally, we urge investors not to cash in their chips just yet, as we believe the game has just begun. Buy NOD.
Okay, great. Thank you for a great presentation. We'll start off with a few questions. I wanted to ask you your thinking on competitive advantage, what the true competitive advantage of the company is. They have 40% global market share of design wins in Bluetooth Low Energy, and you know how do you reason to see this as a sustainable market share going forward?
Yeah, I can start. Their expertise within the BLE market has made Nod the market leader within this technology. And with the macro trends going forward and they expanding into both cellular IoT and Wi-Fi, which is required by their customers, which is already sticky due to the process with developing the chips, we argue that that synergy effect is making Nod unable to take advantage of the growing market, which Sophie talked about earlier.
I can add on to that there. So you have kind of particular to the semiconductor industry, once a chip is designed into a product, in order to take it out again, you kind of have to redesign the entire product, meaning that, say, a Bluetooth device using a Nod chip can't be, it's very difficult to replace. There's high replacement costs. Considering their expansion both into Wi-Fi and cellular IoT, considering they're already very sticky customers. These are sticky customers, and they're also very sort of highly
Diversified portfolio.
well, yeah, but sorry.
Yeah.
To summarize, their competitive advantage could be their people. In essence, Nod is a research company, and they research and find new technologies for their clients. So the people that work at Nod, and they have explicitly said this themselves, that their recruiting process and keeping their clients is a key driver for their future competitive advantages. Also, these people are a resource to move into new markets. And we believe, since all the moves that Nod do is driven by their customers' need, which is a key part of their philosophy, that they want to put their customer first. So every decision that they make strategically, M&A or organically, is driven by their customers' wishes. And we believe that is a sustained competitive advantage, mainly their broad portfolio, the people of Nod, and their market share.
Yeah.
Great. Touch a little bit on the backlog. Have you made any considerations on the quality of the backlog, the risk of double ordering due to the massive global shortage of semiconductors?
That's a really good question. Thank you for that. We have thought about this a lot, and in the Q&A with Nod, we asked about this, and for a client to be able to lay a double back order with two companies, they will have to develop their products with two different semiconductor companies, which will be highly expensive for the clients. So we believe that this is a low risk, middle impact scenario. So if that happens, but we don't see that as very likely, because it will be very costly. And it's not only Nod that has issues with delivering products, since it's a manufacturing problem at TSMC, where the way of their machines that produce semiconductors is highly complex to build. So it's not a Nod problem, it's an industry problem, and therefore we indicate this is a low risk.
Historically, Nod also has very few ghost orders.
Yeah.
Thanks. Do you see any risk of growth going forward, taking a dip below the kind of run rate 25 to 30% CAGR after this massive order intake we've seen past, what is it now, year and a half almost, that there will be kind of a slow period following, which is below kind of the trajectory of Bluetooth? How do you account for that in your modeling?
So the estimates that we've used are industry estimates, and we've also been quite conservative in the estimates we've used with this in mind. We've also made accounted for it in our risk scenario, also in our bear case, where we have identified
just need to get through to the risks.
Yeah.
I
So-
can build on off that because, sorry, just for
Yeah. So in essence, we kind of estimated terminal growth not to be as high as we set it to, because that was kind of our argumentation for terminal growth going forward was this massive expansion.
Yeah, it's really that the whole market are in quick expansions, and also the products that need the chip also need more of the chip because the chips are getting smaller and more advanced. Yes.
And you judges can just think about it yourself. What's the macro trends? How are your behavior within your daily? What do you use? The trend is not driven just by like consume only industrial, but think about what products you use. Look around us. We're
Yes.
surrounded by technology, and that drives the increase of semiconductors as well. And
And that is really just in the West, because we forget to see the emerging markets like in, for example, Africa, who is also digitalizing, using and needing this chip to continue these investments.
But it's also worth mentioning that historically, or in 2021, the supply side on the semiconductor, like TSMC, that's the constraints of Nod's revenues, because due to the rapid demand boom we're all talking about now, TSMC's capacity is very limited now. But as a result of that, we've seen huge investments. Like, President Biden have invested a lot in increasing this semiconductor supply, and a lot of the leading companies within these industries have increased their investments right now. So we believe that the supply side will also react on this rapid demand growth.
Thanks.
I have a question on margin assumptions. You had a very solid margin developments above targets of 25% to 30%. Could you explain how you've modeled that and what kind of assumption you made there?
Well, it's really
From 2022.
Yeah, so as you see, we have a margin expansion from 21, mainly due to our quite conservative estimates that we are seeing post Q4 release. This was because we estimated or argued that we believed it would be like substantial cost due to the supply chain. And further on, going forward, we believe that, or argue, that it has been several or more expenses due to its launch of products and development of this product. But as soon those are launched, we believe that there will be more cost controlling, and which will increase their margins.
And in addition, they will get revenues from these new products that they are launching, which is also helping on those increased margins.
And one question on the management team. Have you had any thoughts on the quality of management and the alignment of interests for long-term strategic long-term growth for the company?
We have had a look at that, because if you look at the Refinitiv scores of Nod, they do quite bad at governance. But we believe that this does not reflect the leadership of Nod, since they have a long-term sitting CEO and have a historically done pretty well. Therefore, we want to lay more weight on the SDGs and how they focus highly on how they focus on the specific SDGs goals or sustainable development goals from the United Nations, as that gives us more insight than scoring systems. Pardon me?
Thanks. A question on the share price move. Maybe it was obvious that the rally last year was driven by massive order intake, solid growth, but have you given any thought to the recent share price performance year to date being down quite massively?
I mainly believe it's due to the tech industry as a whole has get quite punishing by the increased long rates risk-free rate, which will increase their WACC, and so on.
Thank you.
Thank you.
Thank you.